Hello, everybody. A very good morning to all of you here today. So welcome to this webinar that is titled How to Master Macroeconomic Analysis as a Trader. So this webinar is brought to you by Bursa Malaysia and managed by our company, LifeChamp. My name is Shen Chu. I'm the moderator for this webinar. So today we are very honored to have a guest speaker here today with us to tell us a little bit more about Sidrec. Okay, he is none other than Mr. Taysha Nair, a case manager with Sidrec, to tell us more about Sidrec. So we'll take a brief moment to talk about Sidrec before we go to the topic how to master macroeconomic data analysis as a trader. So good morning, Taysha.
Good morning, Shane.
Yeah, how are you today?
Thank you for that kind introduction. Very good, thank you. How are you?
All right, cool. So I will just stop my screen sharing and hand over the control to you.
Yeah, sure. All right, just one moment. Okay. A very good morning to everyone. Thank you for spending some time, with us for this morning. First and foremost, thank you to Shane, for that very kind introduction, and also thank you to Bursa Malaysia for providing us with this opportunity to speak to all of you this morning, and also a very big thank you to LifeChamp as the in their capacity as the organizers for this session this morning. So as Shane mentioned, my name is Taysha, and I am a case manager from the Securities Industry Dispute Resolution Center, Sidrec. So generally, it would come up, what is Sidrec, because most people who do not have a need for our services typically may not have heard about us before. Briefly speaking, what Sidrec is that it is a company that was set up by the Securities Commission to act as an alternative dispute resolution center for claims that involve capital market products or services. So what do we mean when we say an alternative dispute resolution center? It effectively just means it is an alternative to going to court, because rather than having to go to court, and there's no doubt that our court system does some things very well, it can be very time consuming, and it can also be potentially cost prohibitive sometimes. So that's why alternative dispute resolution centers like Sidrec exist, which is to provide an avenue for investors to file their complaints and try and achieve a resolution without having to expend time and money going to court. So we are effectively a component of the investor protection infrastructure that exists within the capital market. And many investors, often when they have suffered losses and they wish to file, claims against their banks or broker or fund manager, they think their only option is to go to court. So that's where, again, we talk about alternative dispute resolution being a quicker, faster, cheaper, and in some instances, a more efficient form of dispute resolution. So our services are free to retail investors. That means for retail investors up to 250,000 ringgit. For claims that exceed 250,000 ringgit, we do have some charges involved. And the main emphasis here is that we do not have a strict courtroom process. It will revolve around the facts of the claim and how the claim is assessed moving forward. So we are ultimately an independent and impartial body that helps resolve capital market disputes through mediation and adjudication. So we are a SC affiliated company to act for monetary claims made by individual investors or sole proprietors against capital market service license holders who are members of Sidrec in relation to any dealing or transaction involving capital market products or services. So Briefly speaking, here are some of the things that we do provide to investors, which is that we are a one-stop center that handles all capital market related disputes. We contribute towards the enhancement of investor protection because we do have reporting functions wherein we do assess data and complaints that are received, and we do ensure that anything that needs to be escalated towards the SC is in fact escalated for their further attention. And ultimately, it enhances investors' understanding because a lot of times we will also spend time to sit down and talk to investors and ensure that they understand what their rights are as investors, what their obligations may be as investors, and what their responsibilities also should be as investors. So who is eligible to file a claim? Basically, you have to satisfy all of these requirements. The first is that it has to be an individual investor or sole proprietor, which means that if you happen to be conducting your investments through a company, unfortunately, your claim would not fall under Sidrec's purview. The second is that it has to be a claim against a Sidrec member. So Sidrec members are capital market and service license holders, CMSL holders that are licensed with the SC. And for a full list of members, you can check our website. So what this unfortunately also means is that we do not handle instances or claims involving scam companies or scam entities. A claim that is filed at Sidrec has to be filed against a registered and licensed member. Third is that it has to involve a capital market product or service. So this is important because a lot of times we see in banks, for an example, banks may offer a wide variety of products, a wide variety of financial products. Some of them may be banking, some of them may be insurance related, some of them may be capital market related. So only if your claim involves a capital market product, and we will get into that a little bit more towards in my next slide, I believe. It has to be a capital market product or service that you are that you are taking issue with for you to file your claim here. Fourth is that your claim has to relate to a monetary loss. So meaning that there has to be an actual financial loss that has been suffered. A lot of times there may be instances where there are hurt feelings and all that. Unfortunately, that is a claim that it also does fall beyond our purview. And the final requirement that we have is that we always want investors to try and resolve it with their investment providers first, at least to attempt to try. So which means that any investor who wishes to file a claim at Sidrec should first have filed a claim with the relevant member, and where either they have received the final reply and they are unsatisfied with the final reply, or where they have received no reply after the lapse of 90 days, then they can proceed to bring their claim. At Sidrec. So here are some examples of products that we do deal with. I think the main example that most people may be familiar with would be shares and warrants. So allow me to just give a very short example in terms of the types of claims that may revolve around shares and warrants. So say, for instance, you are an investor and you have a dealer's representative. So one day you give an instruction to your dealer's representative. You say, please sell at this price. For whatever the reason, the dealer's representative fails to sell it at that price, and subsequently the price drops. Therefore, you can say that you can make a claim that the DR's non-compliance with your instructions has resulted in a loss that you have suffered. Again, I have to emphasize that every single case is different and every single case will turn on its own individual facts. But I'm trying to give a brief example so that for those of you who are wondering what kind of cases we do handle, this is a fairly simple example. So we also handle cases involving unit trust investments, structured product investments, private retirement schemes, private retirement schemes, as well as fund management. So if you have any dispute that results in a monetary loss and you wish to file a claim, then you may proceed to do so at Sidrec. So how can you go about lodging a complaint? So we do accept, so first of all, you can start by going to our website, www.sidrec.com.my, and you can download our dispute and claim form from the website. And subsequently, you can just fill in the claim form and scan or take photos and attach those photos or documents to us as your supporting documentation. And once your case has been assessed as being eligible, then a Sidrec case manager will then proceed to contact you. So a brief overview of what our dispute resolution process is. I think for those of you who were present at the beginning, you would have seen in the video. So the first thing is that the investor is to file a complaint with the member's internal complaint management system, and members have 90 days to resolve a complaint through their internal systems. So where there is no response, or where the claimant is not satisfied with the response, the claimant, and this is important, the claimant has 180 days, which means approximately 6 months from the date of the member's final reply to file the dispute with Sidrec. So once the dispute has been filed, we will then assess the eligibility and merits of the claim. So at this stage, we will normally be sending inquiries towards both parties to understand the concerns of the parties and try and help the parties to resolve the dispute. So if a case is unable to be resolved during case management, then the case will subsequently proceed to mediation. So what a mediator does is a mediator facilitates communication and encourages an open and constructive discussion between the parties. But any settlement that is achieved at mediation has to be mutually agreed to by all of the parties that are present there. So in the event that mediation is unsuccessful, then the claim will proceed on to adjudication. So adjudication is similar to a court process, but rather than having a judge and a lot of documents and a lot of legalese to have to go through, what will happen is you will have an adjudicator sit with both parties and basically go on a fact-finding mission, go through the documents and ask questions. And following the conclusion of the adjudication hearing, the adjudicator will issue a decision based on what is fair and reasonable. And the things that will be taken into consideration is, yes, the individual facts of the case, supporting evidence, applicable laws, good industry practices, as well as guidelines or codes of conduct for judicial precedent. So that is a brief overview of what our dispute resolution process looks like. And ultimately, we do strive to complete our dispute resolution process within 90 working days of us receiving complete documentation from the parties. So once parties have given us complete documentation, then we endeavor to complete adjudication within 90 working days from that point. So if you would like to contact us, if you have any queries or questions about potential claims that you may have, then you can always call us at 03-2282-2280, or you can send your claims and inquiries to us via email as well at info@sidrec.com.my, or you can also reach out to us on social media. We are available on Facebook, Instagram, and Twitter. So with that, I think that will be the end of my session. I would like to thank all of you again for allowing me the opportunity and giving me the time. And I wish you all a very productive session ahead. If there are any questions, I will stick around for a bit to take them.
All right, thanks, Tasia. Yeah, if any questions to ask Tasia, you may write them in the Q&A box, and we will probably take 1 or 2 questions if there are any.
I just want to address, there is a comment from SK Tan, who says that 90 days is so long. And I do appreciate from an investor's perspective, especially if you have lost money, that 90 days is very long. But I also want to emphasize that our aim is to resolve disputes within 90 working days, which means we endeavor to go through this entire process within 90 working days of receiving full documentation from both parties. So that will include case management, mediation, and then adjudication as well. So I just hope that that clears some things up. If there's nothing else, then I will just hand over back to you, Shane. Thank you very much.
All right, thank you so much, Tasha, for the wonderful sharing about Sidrec. So now we have learned an alternative route for us to address our complaint and for us to find a mediation or to resolve our dispute with the member of the Sidrec. All right, so now back to our main topic for today's webinar that is titled How to Master Macroeconomic Analysis as a Trader. Now, macroeconomic is a very important instrument for investors to consider before we want to do investment. Today, we're going to learn how do we incorporate macroeconomic data into our trading consideration. So disclaimer, whatever we share in this webinar is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today. She's a licensed financial planner, certified by the Malaysian Securities Commission Financial Planner Representative License and Bank Negara Financial Advisor Representative License. She is a course trainer and public speaker at Financial Planning Association Malaysia and Bursa Malaysia. Over 25 years in education, she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. And she's also a best-selling author who has published 6 books on investment and financial planning. Her articles have appeared in financial magazines such as The Personal Money, Money Compass, and many more. And she's none other than Miss Pauline Yong. So good morning, Pauline. How are you?
Hi, good morning, Shane. Hello, everybody. How are you? It's a very early morning. Yes.
Yes. So without further ado, let me hand over the session to you.
Yeah. Okay, thank you. So taking over, then I'm sharing my screen from here. So today's webinar is on how to master macroeconomic analysis as a trader. Okay, so we're going to look at macroeconomic indicators. So we are always looking at trading, and then we have to refer to technical analysis. But in this session, we are going to look at, hey, perhaps we are looking at news or macroeconomic indicators that may influence the trade, and then you may have certain trades that is profitable. Okay, so a very good morning to everybody, and very good morning to everybody. So I'm sharing my screen here. Okay, so this is what we are going to cover. What is macro trading strategy? Because today's session is all about macroeconomics. So it is a trading strategy. So we're going to look at it. And why is this global macro trading a favorite among hedge fund managers? And then the macro indicators, as well as the relationship between economic indicators and the asset classes. Okay, so what is this macro global macro strategy? Now, how many of you know Ray Dalio? Does anybody know who is Ray Dalio? So if you have heard about Ray Dalio, you can type a 1. Okay, so Ray Dalio, I spelled his name to you. Ray Dalio. Okay, yes, Ray Dalio. I see that some of you have heard about him. Okay, and in fact, he is the hedge fund manager for the Bridgewater Associate, and he is very successful. Why he's successful is because he can see macro things. He can look into the history, he can look into the future. Okay, so he actually came up with a lot of theories, and one of the important one is on the all-weather portfolio. All-weather portfolio meaning that he designed a portfolio whereby it will withstand all kinds of harsh weather in the financial environment. So what he's good at is actually looking at the macro, looking at the interest rate trend, looking at the US dollar trend, Especially when he started off, he was a Forex arbitrage. They make money from Forex arbitrage strategies. And now I look at him, his strategy is more towards the interest rate and the macro as well. So, so that is why hedge funds, they are so into this macroeconomic strategy, is because it can help them to make a lot of money. Okay, and so let's see. So here, these are the few strategies. They have the currency strategies, and then they have the interest rate strategies and the stock indices. So among these, right, I would say the currency and the interest rate strategies are their favorite, especially when you look at the current 10-year yield treasury note, and you see that the recently, if you notice, the chart is actually forming a big chart pattern for the 10-year yield notes. And if you were to look at that chart pattern, you will see that most likely it will crash for that 10-year yield. So then it could be a very good strategy for the fund managers. I mean, the hedge fund. Okay, the normal fund manager, they can't do derivatives, so it's not applicable for the normal fund. It's for the hedge funds, because they can use the derivatives, the options, the futures, and then they can use leveraging, borrow, and then borrow at a low cost interest rate, and then to long at the currency whereby they think this currency have the potential to increase. So that means they are borrowing. So this is called carry trade. Okay, at the end of the slide, I will also talk about that carry trade as well. So that is part of the currency strategy as well. So, so these are the basically the strategies for the macro strategy. Okay. Towards the end, I'll come back to here, and I just want to go through some of the knowledge about what are the economic indicator. Okay. So, how many of you? Okay, how many of you have actually have some knowledge, or when you are university? Your education background, you have economics background. Okay, so how many of you have economics background? So if you have economics background, you put an E. Okay, so if you have economics background, you put an E. Okay, anybody? Yes, Ellen, and Mo Singh. Okay, and Ching. Okay, very good. Then I see that quite a number of you, okay, you have a economics background. So, if you are still working in the line of the financial industry, most likely you will understand better. However, if let's say you just study 1 or 2 subjects, and then you were into another line, and then you didn't refresh your memory, perhaps the next few slides that I'm showing to you will be a good refreshing your memory about what you have learned last time. So among these macroeconomic data, right, which of these you think will affect the stock market the most? Anybody? Which of these you think will affect the stock market the most? The second one, inflation. Okay, how about others? Actually, they are a little bit linked, but then you can differentiate them. Okay. Interest rate, so many interest rate, and that is because we are currently in this environment. If I were to ask you maybe 3 years ago, you wouldn't tell me it's interest rate. Okay. GDP, yes, I'm seeing GDP here. I think GDP, okay. Personally, I really think it's GDP, because the GDP is actually looking at the financial health of a country. And that financial health of the country will affect all the public listed companies in our Busan, Malaysia. You just imagine, if let's say the country is doing well, people has higher income, and the stock market will go higher. If let's say the GDP is negative, sure, the stock market is in a downtrend. So, but how about interest rate and inflation? Now, because we are in this current environment whereby almost every month, we are looking at what is the FOMC's decision on the Fed rate decision, and which is from the US and also from Malaysia as well. But of course, the US is more concerned with the overall stock market. But if you to look at this, the current issue, right? It actually come from the source was inflation, okay? And the inflation is the CPI. So it's actually coming from the inflation problem because we have inflation. Okay, first, because we have GDP pandemic, okay? Because of the pandemic, our GDP went negative, okay? And because of this, the government pumped in money and then stimulated the economy, and that created inflation. And because of inflation, then you will have to raise the interest rate to curb the inflation. So by raising the interest rate, you are actually trying to contract the GDP, okay, so that you want to bring down the inflation. So this is a cycle. It can cycle to the up and it can cycle to the down, okay? So it depends on how well the government manipulate this interest rate policy. And another thing is unemployment rate. For the US Fed decision, they focus a lot on the job data. And basically, they look at the majority of their decision basis is based on the job data. But however, if you look at the unemployment rate, you can see that it is actually a lagging, okay? It's a lagging indicator. And also another thing is the industrial production, okay? So, but all in all, I think the GDP will be the most important impact on the stock market. Okay, so next, the different types of the economic indicators. So we are looking at leading and lagging. So there's also another one on a coincident. Coincident, I think I didn't include that is because I look at it as a very gray area. So many of that I can clearly classify as a leading or lagging, okay? I wouldn't want to put it as a coincident. Coincident means that it is happening together with the real economy. But a lot of time they are lagging, okay? A lot of the time, those in economic indicators, they are lagging indicators. And what are the leading indicators? So, okay, so if you can see, the leading indicators will be the weekly job data. So if let's say you're looking for the US, the weekly job data, it will be more like a real time because it's every week. It's not like every month. Okay, so it will be every week. And then so you see that currently what is happening now on a week by week basis, how many people are claiming the unemployment benefits. And so you can see that whether the economy are doing well. Okay, and the PMI, for example, now we are in May, right? So the April PMI will be announced on the 1st of May, 1st or 2nd of May. So it will be quite a very fast announcement. So immediately after the month end, you can announce the PMI reading, okay? And the money supply, okay? The money supply will tell you whether the economy is having expansionary or contractionary. So for the past 2 years, because of the pandemic stimulus package, the money supply has been rising very, very fast. And then of course, the most important and the most famous one is this 10-year note and the 2-year note yield spread, okay? So this is the yield spread. So when you look at this yield spread, you are looking at the interest rate between a 2-year note, which is like a bond, okay? 2-year bond, because they don't call it a bond. The definition for the US Treasury is that if it's more than long term, they call it a bond. If it's medium term, they call it a note. If it's less than a year, they call it Treasury. So then this is just a term. So in fact, it's just a function of like a bond. It's like a bond instrument. So if you look at this 2-year bond and a 10-year bond, okay, and basically, if you to look at a normal situation, okay, can anybody tell me under a normal situation, which one is it, the 2-year one, a 2-year bond, or the 10-year bond? Which bond has a higher interest rate? Okay, can anybody tell me which bonds has a higher interest in a normal situation? Okay, in a normal situation, okay, when basically the economy is doing well, okay? 10-year, okay? 10-year note will be a higher interest rate, and that is because you are locking in for 10 years. So for 10 years, you must have a significant amount of risk that you are, if affecting you. So comparing 2 year, you are looking at exposure for 2 years, but the 10 years you are looking at, you are much higher exposure. So therefore the risk is higher, the compensation will be higher. And in the long run, we are looking at the interest rate is rising in the long run as well. So naturally the 10 year will be higher than the 2 year. So always you see that in a normal situation, 2009, 2010, 11, 12, 13, 14, 15, 16, 17. So these normal years, right? The yield spread is positive, 3%, 2%, 1% positive. So these are positive figure whereby, for example, if you have a 2% positive, meaning that this 10-year bond is 2% higher than the 2-year bond. Okay, does that make sense? That means if you hold this bond for maybe 0.5, then this one is 2.5. Okay, something like that. So meaning that this one is higher than this by 2%. Then what happened is, okay, let's Google for the current one. So this chart is a bit outdated a bit. So we could Google for the current 2-year, 10-year yield spread chart. Okay, we Google and then we see the latest one. I think the Y chart have to. Okay, let's see the investing.com. So this is looking at this chart. Okay, where's the chart? Maybe I go to another chart. Wait, this one, 2-year, 10-year, or maybe I go to Yahoo Finance also can. Okay, this one. Okay, so let's go for 5 years. Okay, 10 years. Okay, okay. This one is not easy to read because the red color is the 2-year and the blue color is a 10-year. So this thing is the spread. Okay, so histogram will become the spread because this is the short term, 2-year. Red color is the short term, and then the blue color is the long term. So usually the long term is higher than the short term, and then you have positive here. And the minute whereby your short term is higher, then you have a negative here. So this is a negative. So over the so many years, right? This one is starting in 1960, 1980. Okay, in 1980s onwards, if you see below this 0 line, so this is a 0 line. Below the 0 line, there were not many occasions. You see, not many occasions that you are below 0. So that means there were not many occasions that you were actually having a negative yield spread. So then people are looking at every time when you have a negative yield spread, then that is the prediction of the recession. Okay, US recession. So for example, if you look at this, this is in 2000. Okay, so this is in the year 2000. So then that year 2000, we do have the dot-com bubble, and then the US economy run into a recession. And then another one is 2008. So this one actually before the 2008, it started in 2006. Wait, 2006. 2006, you started to have that negative. So 2008 recession. 2 years. So then they said that whenever you see the negative yield within 2 years, okay, within 2 years, you see that the US will be running into the economic recession. So now we look at this. When did it start? 2020. Okay, so this actually started 2020 when we saw that we have a negative. So which means that within 2 years, by 2022, it will be in a recession. But now we are seeing that the US GDP is still positive. Okay, but however, there were two 2 consecutive quarter they were having a negative, but then they reversed. Okay, so now we are looking at in 2023 and then 2024 and beyond, and see whether, especially this year, and they're seeing that this year the risk of recession is very, very high. Now, how many of you think that this year, okay, for the US, they will run into a recession? Or how many of you think that they are already in a recession? Or how many of you think that they haven't into a recession? Okay, maybe I just want you guys to give me some answers so that I can see how you look at the economy. Okay, how the reason why I want to ask is because I want to train your sensitivity with the market, with the stock market. Okay. Okay, interesting. So I read out some of your answer, and Ching says that already. Okay, Muhammad says that already. The economic damping, but not recession. Okay, because technically recession means 2 consecutive quarter of contraction. Next year recession, Sam say next year recession, and not recession yet, mild recession, recovery going into. Okay, I would think that they are already in a recession, but it's just that it didn't show in the figure. Okay, I would think that the figure haven't shown yet, because recently, the last weekend, Warren Buffett had their annual meetings with their shareholders. In fact, he himself already said that the US economy is in a recession, and many of his companies, he will foresee that their earnings, okay, not revenue, earnings means the profit will be declining this year. Okay, so he said that in fact a lot of his company, many of his companies, the stock level, the inventory level, okay, inventory level started to pile up, and then they have to give discount, promotion, sales, and then they can clear the stock. So in the past he didn't have to do that, but now he has to do that, and which shows that. And another interesting about Warren Buffett is that he is actually piling up his cash reserve to 130 billion US dollar. So you see, if really in a bottom, right? So he should be buying, right? But you see, he's not buying. He's actually piling up his cash reserve. So meaning that we are expecting some some level of recession in the US economy. Yeah. Really, okay. Apple results beat the expectation. Yeah, so the results are usually quarterly results, and then which means that they are the past, they are the history. Okay, so we are looking at forward, which is the future. So future, what do you expect? I would think that there is a possibility, although it will not be 100%, there is a possibility that the earnings may decline. Okay. So it is important to know about all these economic impact, all these economic indicators, and then their impact onto the economy, because we are part of the market participant, because we need to get these information in order to trade or to invest. Either you are the trader or you are investor, you need this kind of information. Okay. Okay, so let me continue at my slides here. So this is the, I would think that the indicators, the jobless indicators, they are the lagging indicator. Okay, although some may think that they are leading, but for me personally, I feel that they are really lagging, because after all, unemployment happens when the economy is already in a bad shape. Okay, why do the company want to retrench? The company want to retrench is because they see that the economy is going downhill, and then they have to stop hiring, and not only stop hiring, but they have to retrench their workers. So therefore, I will look at it as a lagging indicator. Okay, although some of them, they may think that it's a leading, but to me, I think it's a lagging indicator because of that. Okay. And for Malaysian unemployment rate, currently we are below 4%. I think we are around 3 point something. Okay, so we are about, hopefully not back to normal, but then still on a unemployment rate is still high in a Malaysian context, but it's better than the last 2 years. Okay, and inflation. Okay, for inflation rate, the US currently, we do see that inflation is coming down. Okay, but in order to reach the Jerome Powell's 2% of a interest rate target, how many more years you think we can reach there? Because he said that he will not stop, or he will maintain aggressive until he see 2% of interest rate. I mean inflation rate target, right? So that is his objective. He said that 2%. So, but a lot of people are looking at he could be pausing the interest rate. Okay, whether he's pausing or reducing, I do not know. But then the fact is that how many years you think that we can reach that 2%? Anybody? Now we are 4.9, right? 4.9. Not achievable. Okay, in history, right, it will be achievable. But then how many years? How many years? In history, it will be achievable. Okay, when you look at the history, whenever the Fed fund they raise the interest rate to an aggressive level, and then they pause, and then they reduce the interest rate, and then something will happen, and then the inflation will be back to 2% level. Okay, in history we do see that. But then the question is how many years that we will see that happening, in how many years time? Anybody? Okay, based on the history, okay, once trade war between China is over, okay, so that's also another thing. Based on the history, okay, some say 2024. Okay, based on the history, right? In the 1980s, the 2% didn't achieve until 8 years later. The minute the Fed raised the interest rate in 1978 or 79, and then the inflation reached 2% in 1986. Okay, from 79 to 86, many years, right? And for 2008, inflation reached 2% within so the Fed actually raised the interest rate, and then until 2006. 2006, the Fed funds, the Fed chairman paused the interest rate hike. So it was under Alan Greenspan, and then later passed to Ben Bernanke. So they paused the rate hike, and until 2008, the stock market crashed along with the commodities crash. And then only you reach that 2% level. So 2008, and then it reached about 2009, about 3 years time. So now we see that started last year, the Jerome Powell aggressively raised the interest rate 2022. And this year, first half, we are still looking at raising the interest rate. And then people are looking at pausing the interest rate, and then perhaps reducing the interest rate. So with this happening, right? So my guess is that it could be what Charlie say 2024, second half of the year 2024. Okay, it could be along that line, or it could be 2025. Okay, if it's about 3 years time, that would be 2025. So which means that currently what we are experiencing now, it is not a quick solution thing. Okay, it's not like a quick recovery thing. No, it's not. It's going to be drag a little until you see that there will still be volatility in the CPI figure. Okay, the CPI figure will still be volatile because of the interest rate reducing and then increasing and then pause and then all this effort, right? The CPI will be adjusting. Okay, but however, you need one dramatical event. You need a dramatical event to bring the CPI down to 2%. And what is that dramatical event? That is, according to the history, okay, if you look back at the history, that dramatical event is recession along with the stock market crash, along with the commodity market crash. Okay, you must have these two conditions, then you can reach that 2% level. So when would that be? Not sure. Okay, I'm not the like a fortune teller or anything. Nobody can predict the market. Okay, but along these few years lah, you will see. You'll be able to see. Okay. Then we look at annual GDP. So annual GDP, as you can see, we are always looking at the economy, okay, as a whole, and then what's the financial health of the country. So in the past many years, there were not many occasions that we were actually below that 0%, which is negative. And in this case, the last negative was 2020. Okay, so that was very abrupt. Okay, so it was a flash kind of a negative, and then it bounced off because of the stimulus package. So these events happening, and the stock market is usually at the bottom. Okay, so that's why the stock market has a very, very close relationship with the GDP figure. Okay, in fact, if you were to do some modeling, okay, let's say you are in the line of a research analyst, and research analysts, they do modeling. So when you do modeling, right, I would think that you will include this GDP into your modeling figure, because this is the main driver of the stock prices. Okay. And where do we get all this information? We can get from the Bureau of, these are the US economic data. The reason why I'm sharing with you these US economic data is because the US economic data affect the US market, and the US market affect the rest of the world. So that's why you see that my focus is usually on the US economic data, because that is affecting the market the most. Okay, I'm looking at affecting the stock market the most. So what is that? Will be the US macroeconomic data. And the World Bank, International Monetary Fund, Trading Economics. So this is my favorite website. I always get information from tradingeconomics.com and OECD Investing and Yahoo Finance. Okay, and among these, okay, so let's take a look at the Trading Economics. Here, tradingeconomic.com, this website, it is really very comprehensive. Okay, so it has all the countries in the world economic data, including Malaysia. Okay. So here we are looking at this country list. So at the one glance, we'll see that the GDP year-on-year, quarter-on-quarter, interest rate, inflation, jobless, government budget, debt over GDP, current account deficit, and the population. Okay, the population is for you to calculate your GDP per capita. So when you look at one glance here, right, you see here is green, and then here is red. Okay, so when you see red color means that alarm, okay, alert, alarming. So what is alarming? The inflation rate is alarming, and then the jobless, unemployment rate is rising, and the government budget is negative. So this is alarming, right, in red color. Then this one, the interest rate will be interesting. So when you see that this is in blue or in green, okay, blue or green, it means what? It means it is rising. So when it is rising, it may not mean good, it means bad also. So this one, if it's green or blue, it is rising, so it is also bad for the economy. So this 4 column. And this GDP has to be good. Green means okay, no problem. Okay, so the green means that it is actually quite okay. So then where is Malaysia? So let's look at the GDP quarter on quarter, and then you can see that all these countries, they are having 0. The Eurozone are all 0. Okay, and some are negative here, Russia. And Malaysia, we are here. Quarterly, it's a negative GDP. Okay, so but year on year, we have a positive GDP. So which means that quarter to quarter is negative, and then the year on year is positive. So meaning that this quarter to quarter, we cannot have another negative for the next quarterly. If let's say we have another negative, okay, Malaysia. If let's say we have two consecutive negative, okay, two consecutive negative of the GDP, quarterly GDP, so we are technically in recession. That is the word called technically in recession, okay, meaning that you are just technically in recession, but may not mean that you're in recession. So they're just arguing. So, but anyway, it is a good reference point for you to see that the economy is actually slowing down, okay? And there's also another one about the inflation data. Okay, I want to ask you guys about the inflation. Okay, so the inflation data that we always know is called CPI, right? But have you ever heard that sometimes they do talk about the core inflation? Okay, so can anybody tell me what do you mean by core inflation? What does that core include or exclude? Okay. So yeah, Shirley, yes, no food and energy. Okay, no energy and then no food and energy. So which means that they want to exclude those volatile ingredient into this basket of that CPI basket. So you have a basket, right? So you want to exclude those volatile things. So they think that the food and the energy are very volatile, so they do not want to include. And then this basket will include only the other than food will be like your utility bill, your education, your rental, your whatever you buy on a daily basis. Okay, on a daily basis, whatever you pay for it, those will be under this basket of goods. And so that will be the core inflation. Okay, and what is the difference? The difference is just that if let's say you want to know the inflation level, exclude the energy price, because now we say that the crude price is always rising, right? So if we say that we want to exclude the energy price, then we want to look at that core inflation and to see that what is the difference. And if we see that the difference is actually very minimum, so meaning that it could be there are other things that are also increasing in the prices. It could be the rental, it could be the utilities, it could be many things that are increasing. Okay, so have you ever heard of another inflation data? It's called the personal consumption expenditure, PCE. Okay, how many of you have heard about PCE? Anybody? If you have heard about PCE, you put yes. Okay, anybody heard about personal consumption expenditure? Shirley again. Okay, so yes, PCE stands for personal consumption expenditure. So if you were to refer to that PCE, their inflation is about 4 point something, and then the core, I mean the CPI is about 4.9 or 5, right? And this PCE is actually lower than the inflation data. Now, then what does this PCE include or exclude? What do you think? The PCE include or exclude what? Actually, it excludes the rental, the shelter, okay, meaning the cost of the housing. And if you look at our expenses, our expenditure, so our day-to-day expenditure is surrounding with our rental, our mortgage, and our utilities, our food, transportation, and then education, and all these many things. So if you are looking at this, right, and if you look at the CPI, it will include everything, all of this. It will include all of this. But however, if let's say you want to exclude certain things, if you think that the house prices, it will skew your data way too much, then you just take out the house data. Okay, so for example, if let's say your country is running like a property market boom, so then this property prices will increase a lot, and that will affect your CPI. So but however, you want to exclude that, you think that it's like a short-term event, it may not last long, and then you want to exclude, then you have to look at the PCE. Okay, personal consumption expenditure, whereby you do not want to look at such a big ticket item to be in the expenditure. So, but to me, I think the CPI will be the best because that will include everything. Okay, so I would think that the CPI will be the best indicator. So we will just focus on the CPI. Okay, So then we go on. Okay, so now we come to the strategies part. Okay, because we have been looking at talking about the knowledge thing, right? So what is this economic indicator? What does that do? The knowledge thing. Okay, then the next thing is about strategies. So when it comes to the strategies, there are two types. Okay, basically there are two types now. Whatever you do, there are basically two major things. Okay, one is that you want to follow the trend. Okay, and then another thing is that you may want to do a risk management as well. Okay, either you are on a offensive attack mode or you are on a defensive. Okay, so whatever it is, okay, whatever it is, you can do both at the same time as well. So whatever it is, your objective is you want to maximize your portfolio return, and then you want to try to reduce the chances of a drawdown or a negative. Okay, so then the first one that is very common is called the trend following. So this trend following strategy is to identify the main trend. Okay, and then you believe in this main trend and then you just go ahead. Okay, so for example, you look at the trend of the interest rate. Okay, so what is the main trend of the interest rate at the moment? Anybody? You think the interest rate is up, pause, or down? I asked a lot of questions. If you think the interest rate is up, pause, or down? Okay. Many say up, and then one say pause. Okay, many say up. Okay. At least you didn't say it's down lah. Okay, at least it's pause or up, right? For the US, they still increased the interest rate. Okay, and a lot of people, they said that they will be pausing by next FOMC meeting, but this didn't happen yet. The pausing of the interest rate have not yet happened. And even for Malaysia, we just raised our OPR. Okay, although we said that we're going to pause the interest rate, we have to wait until the next meeting, then only we know that it will be a pause. Not yet happened. Okay, so that's why all of you say that we are still up. Okay, so when you are looking at the interest rate going higher, right? But however, we also understand that they are going to pause the interest rate in the near future. Okay, so that is the market consensus. So sometimes when you look at the trend and then you look at the indicator, you are looking at what is being published, what was being announced, okay, what was being released, but it didn't look at all this macro economic data, right? It didn't really looking at what is looking ahead, forward looking. It didn't really tell you so much about what is the future. Okay, so when you are looking at this trend following, right, a lot of the analysts, they will incorporate their own expectation. So their expectation will be coming in, and this expectation become the trend following. Okay, the expectation become the trend following. So if everybody expect the same thing, then everybody will create a trend, and then the rest will follow that trend. For example, if you think that the interest rate is going to pause, and maybe in some months ahead it may reduce. Okay, so if you think that the expectation is going to be like that, then a lot of the people, they will be looking at buying into the bond market, because interest rate go down and then the price will go higher. They buy in the bond market. And then another thing, the US dollar, they will short the US dollar. Okay, because they think that if everybody think the same, the interest rate is pausing, the US dollar will stop rising and then it will start to decline. Okay, then that will be a turning point for the USD, and where that turning point happens, then you develop a trend. So that trend will be a falling dollar trend. Okay, so So the importance here is that you identify the economic indicator, like the interest rate, okay, and then what is the expectation, and then with this expectation, then you develop a trend, and then this trend, if more and more people believe in this trend, then it will happen, and then it become a trend following. Okay, so once, for example, the 10-year yield, okay, if once this trend develop, you see the 10-year yield will crash, and then the US dollar will crash, and yeah, okay, basically these two will come down, okay, and then the trend will develop. Okay. So if let's say you are a hedge fund manager, okay, knowing that this the trend is developing, what would you do if you are a hedge fund manager? Actually, later I have a hedge. I think
one report.
Yeah. Somebody say something. Is it from my here? Okay, wait. Anyway. Okay. So so if let's say the hedge fund, right, when they know that if they are doing the arbitrage, then they will do the carry trade. Okay, so later I'll go into that. Okay, never mind. So the next one, the next strategy, macroeconomic strategy, is the mean reversion. So if you know that in general, okay, if a certain asset drop too low, okay, for example, before the pandemic or during the pandemic, 2020, okay, the middle of May 2020, what happened to the crude oil price is that it crashed. The futures market for the crude oil actually crashed to a negative value. Okay, so that was unprecedented. I have never seen the oil futures to crash to negative, and it's not a small negative, it's a big negative of -37. So that was unprecedented. But nevertheless, the spot market also go down. So when you see that a certain asset class going down so rapidly in a short period of time, then this reversion of the mean will come in. Okay, reversion of the mean is that when things get too depressed, sell down, overly done. Okay, the sell down was overly done. Then you believe that eventually you will revert to your mean. Your mean will be your average price. Okay, so let's say the mean price for the crude oil is about $40 during that time. Okay, $40, $50. Then that -37 is a buy opportunity. It's a golden buy opportunity, because you know that you cannot be deviate from that mean for too far. It can't be too far from 50 to -37. So it's a great golden opportunity. So whenever the asset price, either it move up too high or it crash down too low, those are the strategies. Okay, so buying strategies whereby people will take this opportunity and then they will buy on these assets and then wait for these assets to revert to the mean. Okay, then another one is the news trading. A lot of people, they think that the technical analysis, of course, is the only thing, right, to the trading world. But however, we also see that there are a lot of traders that also listen to the news. They trade on the news, okay? And one of the major news will be the non-farm payroll and inflation data. And now is the interest rate, data, okay? So before the pandemic, it was a non-farm payroll. Everybody was talking about non-farm payroll. Now, in this 1.5 years, everybody is eyeing on the interest rate now. So the interest rate become the mainstream, the most important economic data to watch out for. So sometimes people want to wait until 2 a.m. in the morning. Anybody here wait until 2 a.m. in the morning just to wait for that interest rate announcement? Anybody? Okay. You guys are still okay, not so crazy about the stock market. Okay, so sometimes really, Charlie, okay, yeah, so that means you are really traders already, because you really follow the trends so closely. Okay, so it shows that you are a very trend following person. So if you are looking at this news, right, it will definitely affect the portfolio. If you are trading position, right, it will affect it a lot. Okay, and Shazila says that prefer to read in the morning. Okay, so I need my beauty sleep. Okay, yeah, I also need my beauty sleep. Okay, so so the news also include the economic calendar. Okay, so when you talk about trading with the news, it will include the economic calendar. And also I want to say is that when we talk about the news, right, this news report. Sorry, so we start out. Oh wait, yeah. Do you hear any noise? Okay, I didn't share the okay because
yes, I heard it. I think it's from your laptop, I guess.
From my slide, because this slide is supposed to be a video. But anyway, I will mute this video. I tried. There's all. Okay, never mind. Okay, so whenever you want to trade news, right, there are many types of news. Okay, so economic news is the major thing. Okay, but however, besides the economics news, there's also another news. Can anybody tell me what other news is also impactful to the stock market? Politics. Okay, this one is good because it's Malaysia, right? Okay, Malaysia politics. Okay, war, yes. Earnings. Okay, my earnings are considered microeconomic data. War. Okay. Anybody talk about natural disaster? Natural disaster. Okay. Now, what happened was that in 1995, okay, 1995, where I think it was Brazil or Mexico, where they had a very severe drought. Okay, the harvest affect the harvest, so therefore that affect the commodity prices. So that was 1995, and then the year 2011 or 2012 in Japan. Okay, in Japan, it was the month of March, and there was this place, there was a tsunami, earthquake. Okay, and that affected the nuclear plant, and the nuclear plant was affected, and that caused a lot of destruction. Okay, so that was because of the natural disaster, it affected the stock market. And sometimes because that was in Japan, so Japanese is the Asian market, so Asian market may not be affecting so much, but however, if it is a natural disaster in US market, heat wave, now it's heat wave, natural calamity. So does anybody remember there was one natural disaster happened in the US that caused the stock market to shake a little bit as well? Okay, it's not like a severe stock market crash, but it does affect for about 1 or 2 weeks time. Did anybody recall? I think it was the year 2005. 2005, there was a natural disaster in the US that affect the stock market. Anybody? No, it's not earthquake. Hurricane, yes. What's the name of the hurricane? Can anybody remember? Is it something to call Katrina? I'm not sure whether it's Katrina or something. Okay, so but that was my memory that it was a hurricane that caused massive destruction into a lot of the cities, and that caused the stock market. Sandy, okay, it could be Sandy. I cannot remember the name, so it could be Sandy. So that caused effect on the stock market. So therefore, hedge fund managers nowadays, if you look at what else do they read, the news, right? They are looking at the news, trading on the news, right? What else do they read? So they read about the natural disaster. Where is the possibility of the next possible natural disaster? And then they also look at, of course, the war you can't control. Okay, the war is because the conflict between countries, and that has been long ongoing, and then it's just you need some trigger, and that trigger will make a war happening. So for example, the US keep in making the Ukraine, and then making the Russia angry, and then finally Russia send the troops to conquer the Ukraine, and that's because somebody triggered it. So then similarly, if let's say China and Taiwan, okay, so if let's say US keep keep triggering the between these two countries, then maybe there's a possible war as well. And another possible war will be between the North Korea and the South Korea. Okay, so but all this, it doesn't happen until there's a trigger. So all this will be the news, and then it will affect. And you have to look at where. If it's happened in the US, it will be more. Okay, the effect will be more. And if it's also happened in the Asia, also effect will be more. And another thing is that for Malaysia, political news, okay, it will affect the most. So next, we look at the economic news. So when you look at the economic news, we are looking at the investing.com, trading economic, and then Bloomberg news. Okay, so all this we will see those economic figures released, or even CNBC, you'll see breaking news, right? It will flash out. So then the dates, okay, the dates of the announcement. So for example, before the pandemic, people look at the non-farm payroll because that was basically everybody was trading around the non-farm payroll. And that was first Friday of every month, okay, the job data. And now it is the FOMC meeting. So I'm sure all of you know that there are 8, in the calendar, there are 8 FOMC in a year. Okay, so all of us who are into the stock market, we will go in and then search which are the dates, what are the dates. Okay, so we just had one on the 3rd of May, and then the next one will be, I think, on the 13th of June. And then after the 13th of June, there'll be another one in July, and then subsequently another one in September, and then another one in somewhere in, I think, October or November. So you are looking at so many more FOMC meetings. So if there is still rising of an interest rate, you could have potential keep raising the interest rate. Okay, so then when you are looking at trading the economic news, especially trading the interest rate, okay, then there are 2 strategies. Okay, either you trade before the news announced or after the news announced. Okay, now let me ask you, would you prefer to trade before the news announced or after the news announced? In this case, will be the interest rate announcement. Actually, there's no right or wrong. Both also can make money. Okay, I have to say that both also can make money. It's just your personal preference. How much is your risk appetite only? Okay, how much is your risk appetite? I can see that Albert said before, and then Muhammad say after, and then Paul say before, and then Julie say after. Okay, there's no right or wrong. Both also can make money. So if let's say you trade before, okay, how can before make money? So for example, last week, okay, last week on the 3rd of May, okay, 3rd of May, we had the FOMC meeting, okay, before the 3rd of May, and the market consensus, they are looking at, if you ask 10 people, 9 people will tell you 0.25%. Okay, so that was the market consensus. It was so obvious, too obvious. Okay, so sometimes when the expectation is very obvious thing, sometimes the expectation is a surprise, and then sometimes you can't tell, you can't predict, you can't tell what's going to happen, but sometimes you can predict very well. So for this May 3rd, it was quite a predictable outcome. Okay, so it was quite a predictable outcome. So in this predictable outcome, you can either go before or after because it's rather predictable. Okay. However, if let's say it is non-predictable, you think that the risk is too high, okay, the risk is too high, then I would think that before will be better. Okay, before is better is because you buy on rumors and then you sell on fact. But the thing is that before the fact, you see the profit there, you take profit already. Okay, so for example, you think that the interest rate is going to increase the interest rate. So what you do is that before leading to the interest rate, you can long the US dollar. Okay, you long the USD, long, and then before you see, before maybe days before, maybe 2 days, 3 days before, you see that you already reached your target, you can start to take profit already. because you don't want to see any surprises, because your risk appetite is not that big. Okay, but however, if you want to wait for after the announcement, then usually this risk is much higher, because you have to make a guess, and your guess has to be better be correct. Okay, have to be better be correct. But however, you have options. You have the derivatives market. The options is that you can do a strategy whereby it can go for long a call and long a put, whereby in 2 ways you can still make money. Okay, unless you do that, then you are still okay. But if let's say you are taking one position, then you have to be careful, because you have to be correct. Then only you can make that money. If you are not correct, you have to cut loss. Sometimes what happens, you have a gap down. Okay, so gap down, cut loss is very difficult to cut loss in a gap down situation. So that is trading with the economic news. Okay. So here we come. Carry trade. Carry trade is a strategy that involves borrowing in a low interest rate currency. So what it means that, can anybody tell me, maybe last year, last year, if you want to do a carry trade for Japanese yen and US dollar, so what kind of you will long which one, short which one? You will borrow which currency, and then you will what would you do if let's say you are looking at the Japanese yen and the US dollar? Anybody? Last year, okay, not this year. This year turning last year. Anybody? Okay, what this mean? Carry trade, it means that, okay, Lily, you borrow Japanese yen and then invest in the USD. Yes. And last year so happened is that the Japanese central bank, yes, we also correct. And last year, the Japanese central bank, they didn't follow the US to raise their interest rate. They reduced their interest rate. Remember, they didn't increase, but they reduced. So they are doing opposite. And this opposite, right, is very good for the Forex trader. Okay, it's very good for this carrying trade, because you borrow at a cheaper interest rate, at a cheaper yen, and then you invest in a rising USD. Okay, so that was last year. And this year, I think you better have to do the reverse, or at least you don't do anything. Okay, you don't, I wouldn't think that you should initiate the reverse first, because we haven't stopped raising the interest rate. This action haven't happened. Okay, the interest rate haven't paused yet. Okay, so we cannot assume that the reverse is going to happen. What if June 13, the interest rate hike again? Then your strategy will be affected. Okay, is it reverse trade like gambling or betting against? Well, there is, in fact, trading is about all this. I mean, there is a risk. You have to calculate a certain amount of risk. It's about probability. Okay, so however, if you are knowledgeable, and then after you assess, analyze, and then you have come up with a conclusion that I see that the probability of having this outcome is 75%. Okay, 75%. Then I will go ahead with my strategy. Okay, so then of course you must have a alternative solution. What if it didn't happen? Then what is your cut loss point and things like that? So yeah, we have to guess. We have to make certain guesses. But it depends on your risk. For me personally, I am more on a risk averse person. Okay, I dare not take on too much risk. So that is why for a lot of situation, I will just stay on the sideline and then I'll just observe. Okay, because I dare not take on unless I see that the chances of winning is like almost there. Okay, almost you will get it. Then I will go in. Okay, so I'm more on the conservative side. So it depends on your risk preference. So if let's say your risk preference is more on a higher side, then you can always do something that you anticipate, and then you act on that anticipation. And there are also other form of investment. So something like this kind of a carrying trade. So if let's say you have a zero cost like a arbitrage opportunity whereby your borrowing cost is a very low interest rate. Let's say your company, okay, let's say you work for a company that can give you personal loan of 2% or 1.5% or 2%, okay, and then there is a sure gain bond of let's say this bond is a government bond, which is a sure gain, which is no risk, zero risk bond, and it's giving you 5%. So your cost is 2%, and then your return is 5%. So then 5% minus 2%, then your net gain is 3%. So therefore, this is a zero cost kind of sure gain opportunity, arbitrage opportunity. So if let's say you happen to see this, by all means you go and grab it, okay? Because this is a zero risk opportunity. But however, if let's say we are looking at the open market, you are borrowing and from the bank, whereby this bank interest rate is fluctuating. It's not a company, it's a bank, whereby interest rate is fluctuating. So then your risk is higher, because who knows, they may increase the interest rate after you have entered into this agreement. They may increase the interest rate, and then it may make this the holding not profitable. Okay, so all this risk. But anyway, so this carry trade is a very, very good strategy. And in fact, it is one of the hedge funds' favorite strategies as well, especially when they are dealing with the currency, the Forex. Okay, so that's why I told you just now in the beginning, Ray Dalio, he started his hedge fund by doing Forex arbitrage. There are many forms of arbitrage. So Forex arbitrage is the most popular strategy. Okay, and of course this when anything to do with Forex, right? Anything to do with Forex, it will be on a macroeconomic data, because after all, what affects the currency value is the fundamental of the country. Okay, so can anybody tell me? Okay, so if let's say, what's the relationship between the interest rate and the currency? Can anybody tell me the relationship between the interest rate and the country's currency? Let's say money supply. Okay, if let's say our Bank Negara increase the interest rate, in theory, what happened to our valuation of the ringgit? Direct relationship, currency up. Vivian, yes, up, increase. Sheila, yes. Okay. Stephen, yes. Okay, so in theory, okay, I have to say in theory, because in theory, when interest rate increase, the value of the dollar will increase in theory. But however, there are so many factors. Okay, so Albert say money supply. So there are so many factors affecting the valuation of the currency. Okay, so money supply is one. Another is the political news, political instability, and all this news. And others are like your macroeconomic financial GDP figures and all this. Okay, and all these will actually affect your currency. But the most is the interest rate. However, if you would like to think of this interest rate have a direct relationship with the currency, right? But after a certain level, the interest rate may not be useful anymore. For example, Argentina, Venezuela. Okay, so what happened to Argentina and Venezuela? Anybody? Their problem, what's their problem at the moment? Argentina and Venezuela, devaluation. And if you check the trading economic, right, currently their interest rate is almost like 30 to 40. Their inflation is about 30-40%, and same as their interest rate. So they are having a hyperinflation. Yeah, that's right. It's a hyperinflation. So then with the hyperinflation, their currency will also depreciate because of inflation. And another reason is because they are raising the interest rate. So because they are raising the interest rate too high, okay, because they are raising the interest rate too high, it didn't help the economy, but in the end, the currency depreciate further. Imagine you want to save your currency. If let's say your currency is being depreciated, and then you want to raise your currency by increasing your interest rate. But I have to tell you that it's only up to a certain level that you can increase. Beyond a certain level, no matter how high you increase, no use. The currency will keep dropping and dropping and dropping, because people saw that you have increased your interest rate too much, you contract your economy, your GDP, everything will be down, so your valuation will be down as well. Okay, so there are so many factors affecting all these economic data and their interrelationship. So it is not so direct. Although in theory there are some direct relationship, but there are also other factors. So that's why we need to read more and then improve our knowledge. Okay. And another one is the event-driven. Event-driven is something that a lot of the fund managers as well as the traders, they are also very much into it. Now, for example, Malaysia, there's last year, election, okay, during the election, before the election. So that was event-driven. And budget, before the budget, that is event-driven. So if let's say you want to have a position before all these important events, make sure that your prediction is correct lah. So I remember there was one year, 2021 budget. Okay, it was an October budget. It was a pandemic budget under our previous prime minister. So I was thinking, because I was trading the futures, the FKLI, the futures, the derivative market. So I was looking at the situation. I said, okay, now we are in a pandemic and the current government is so generous in giving out the goodies to the people. And then, so most likely this budget is going to be people friendly. Okay, so that was my analysis and then my prediction. And then, you know, I'm always, if I think that the outcome is not more than 75%, I wouldn't enter into that position. So meaning that I must think that the outcome has to be more than 75%, then I will enter. So which means that this analysis, to me, it is a very natural and a common analysis, which means that this current government, generous, it will give a lot of goodies, and then it will be a people-friendly budget, and then I long the FKLI before the budget, and then after the budget I will take profit. Okay, so that was my. So guess what happened? Can anybody recall what happened that year, 2021 budget? What was the highlight of that year? Anybody recall? 2021 budget. Cannot recall. Do you follow the budget? Because for the stock market, more money, more money, but there was one thing that caused the market to get down the next day, on the Monday. More money, no. Tax, okay, what tax? Ping, what tax? What's the name of the tax? Yes, okay, very good. Oh, Cukai Makmur, that was the tax. Okay, so that prosperity, no, it's not the windfall tax. Okay, windfall tax is for the glove industry, but this prosperity tax, Cukai Makmur, is actually aiming for those big corporations with 100 million and above profit will be taxed 10%. Okay, I'm looking at 2021 budget, not this year budget. I'm looking at 2021. So that was a news, a very surprise news to me, because when I was listening to the news and then I was reading the budget, and then I keep repeating, what? 10% on the 100 million and above company. Then I was like, oh no. Okay, so the next day I have to not only I did another thing. Okay, I didn't cut loss. Actually, I short another contract. so that I want to freeze my equity. So I continue to long, but then I short another contract because that contract is a many months contract. It's not a same month contract. It's a many months contract. So that happened to be the strategy during that time. So what happened is that after this news breakout, the next Monday, gap down. So gap down, and then it continued to go down, and then for one whole week it was down. Okay, down about 100 over points before it reverses. Okay, when it reverses, it was very strong as well. It was up 100 points as well. So that's how I managed to prevent my losses, and then I managed to make some small gains only lah. Okay, so that was the situation whereby you were expecting something that sure, almost like, you know, you think that it's going to be happening, but then in the end there's a surprise. So then you have to react with another strategy. Okay, so this is event driven. Okay, so event driven is something that we are definitely having some opportunity. Okay, it could be election also. Okay, so during that time, a lot of rumors, they say, oh, this party, that party. But to me, I feel that at that time, the probability of a hung parliament was very, very high. Okay, so that was the thing that actually happened. Okay, so the next event that we are looking at is the state election. Okay, so hopefully there's no surprises in the state election. Okay. So another thing about all these macroeconomic, right? We can use it, just now in the beginning, I said that we can use it for profit, right? To try to take advantage of the news and event. But in the meantime, we can also use that for risk management. Okay, so identify the potential risk. For example, if the interest rate keep rising, we identify this potential risk, then maybe we need to do some hedging. Okay, if let's say we see that the commodity prices keep rising, then we also need to do some hedging in the derivative market. And you have to anticipate the market volatility. Okay, so market volatility is something that we can manage. So just now I did mention one strategy is the option strategy, whereby you can do a long a put and a long a put and long a call. Okay, a bull spread, you can long a put call and long a put, and then if there is any volatility, you can still make money. Okay, and your loss is just your premium. And diversity, you can diversify your trading portfolio, because when you know that certain sector is losing value, so maybe you need to diversify into another sector. Okay, let's say, or you identify that certain sector are increasing value, then maybe you need to diversify into that sector. So for example, you see that the gold price, okay, the gold price at the moment, what is the market consensus? You think the gold price is going up or down? Yeah. Yeah, okay. Lily say up. Okay, so actually, yeah, that's what I'm thinking too. The gold price, I think they are general in terms of the commodity, because gold is a commodity, and then the crude oil is a commodity. But why is it that the crude oil is not doing well, but then the gold is still managed to do well? And that is because if you look at the gold, very much one of the main factor, there are many factors. One is that, number one, inflation, fear of inflation. If people think that this inflation is going to persist, then the gold price will increase, because we want to find for alternative to preserve our valuation of our currency. Another thing is the US dollar, okay, because when people, central banks, currently US dollar is a common reserve currency value, right? So if let's say you are looking at this reserve currency status, they are trying to cut down because the US dollar is going to depreciate because of the lowering of the interest rate. You are thinking that the US dollar may go down, so then people will have to switch to other alternative. So other alternative will be currently it is still the gold, but in the future it will be another currency, which is called the BRICS, BRICS. Okay, so the BRICS stand for Brazil, Russia, India, C, China, and South Africa. Okay, so these 5 countries, and it could be more. So we are looking at these countries, they form a block, and then they will create their own currency. And when you're looking at trading among these countries, and they are trading using the BRICS currency. So this BRICS is going to replace the US dollar. So you see all these are happening, and we are going to see that the US dollar will lose its shine. Okay, so when you identify this macroeconomic condition in the market, you identify, then you have to do some risk management. So what are the risk management? Then you will have to cut down on the dollar denominated assets, and then maybe you want to put into gold, or you want to put into other assets that you want to protect your even if you put into a fixed income is also okay, because you just want to protect your portfolio. Okay, and of course the hedging is always good. Okay, hedging, and how you can do the hedging is usually done by the derivatives, the futures, options, and all these derivatives instruments. Okay, so I think we have about 15 minutes for the Q&A session. USA happier. Oh, why USA is happier? You mean when the US dollar go down is happier? Or what do you mean, Albert? What do you mean by USA is happier? I would think that USA, they are worried. So that's why they want to keep pressing the China, and yeah, no less USD held overseas. Okay. Actually, doesn't mean that, okay, I want to say is that when I say that the potential for the US dollar to reduce, right, doesn't mean that you want to sell all your US currency. No. What I want to say is that you have to, maybe instead of buying into a US denominated, you still have some US denominated, okay? But however, you need to diversify into other currency, perhaps China yuan or Sing dollar. Okay, yeah. So it's not like totally out of that USD. How do you see the Busan market? It is boring. Yeah, indeed. But however, I believe in ASEAN. ASEAN 10 countries, I believe in this economic trading block, whereby in the next few years, it will be doing very, very well. Okay.
Pauline, before we address the Q&A, can we look at shall we look at the equity trading simulator?
Oh, sure. Okay. So sorry about it. I forgot about.
In the meantime, if you have any question, write in the chat, write in the Q&A box. Don't write in the chat box. Write your question in the Q&A box.
So
okay,
I
so we address your question
for you guys, and I will teach you step by step how to open this account. Okay, so this simulation platform is a very, very important for beginners, especially if you're a new beginner. Okay, what you need to do is that you need to register with your Gmail. Okay, after you register, and then you can log in. So this one is called Busan Marketplace. Okay, so I give you this link, and then you can click on your. You can click here. Okay, so then you click here, then you go into that Busan Academy simulator. Okay, so here there is this simulator on the equity simulator. Okay, how many of you have already become the member of the Busan Marketplace? How many? Okay, you put a 1. Okay, if you are already the Busan Marketplace member, you put a 1. Okay, if you haven't, you put a 0. So I want to see how many is 0. Okay, so I want to see how many is 0. So if you are in, you put a 1. Okay, so okay, so Albert, Janice, Alvin, Yvonne. Okay, you do this registration now. Okay, you do this registration now, and then you log in using your Gmail. Okay, Yvonne, Alvin, Sing Hop. Okay, you log in, you click the link that I share with you, and then you log in, register using your Gmail. It can be any of your Gmail. Okay, so or it can be any of your email address. So I usually use a Gmail. And then after you log in, then you come to this Bursa Academy, and then under Bursa Academy Equity Simulator. Okay, so here we are in this platform. So this is a live trading platform. So what you can do, you can, you're given 100,000. How's that? You're given 100,000 paper money. So with this 100,000, you can start to learn how to trade. Okay, so Yvonne, Elvin, and Sing Hop, is it okay? So it is a very good simulator platform for you to train your knowledge. Okay, so the very first thing, usually I will do a watch list. Okay, a watch list is whereby you can put everything that you want to monitor in the watch list. So let's say you want to buy the banking stock. Okay, so then you key in Maybank. Then you key Maybank, and then the Maybank will come out, and then you right mouse click and you add to the add to watch list. Okay, so you create a watch list first. So create a watch list. Create watch list. Okay, so then this one will be the banking stock. Okay. Here. So then you click here and then you add to the watch list. Yes. Then you click add. Okay, so Maybank is added to your watch list. So then you can also do that for public bank. So the next one is public bank, and then you put it in your watch list. Okay. And recently, another friend of mine, he said there are a lot of people buy into the NBSB and then feel that the NBSB is very boring. But however, I told him, if you notice, the dividend is very good, NBSB, right? So you just hold on to it. When the market recover, it will you will have your price appreciation. But at the meantime, you just focus on the dividend. Okay. And then so here will be your watch list. Okay, so you view your watch list. So here will be your watch list. Okay, so then when you want to monitor, you just monitor your watch list, and then you see whether the price has reached to a level that you are willing to buy. Okay, because some of you say the market is very boring, but however, these are the time for you to accumulate some good value dividend stocks. Okay, so maybe last 2 years I've been talking, maybe I will say, okay, buy the technology stock, right? But this year I don't talk about technology stock anymore. I talk about dividend stocks. Okay, so this year I've been sharing that try to buy into the dividend stocks, because now, although the market is boring, but you still receive your dividends. So the strategy for a boring market is dividend stocks. Okay, does that make sense? Okay. Then the next thing is that you want to learn how to make a buy order, right? So this buy order is, you see, you make a buy order. Let's say you buy. Okay, you click, you right mouse click and then you click a buy. Then this thing will happen. Okay, so see, you have a 100,000. Okay, so of course you don't put all money into one basket. So to me, I usually will go for sectors. I will identify 5 sectors that I want to invest. So can anybody tell me which sector has dividend? Can you type in the chat which sectors are dividend stocks sector? Okay, REITs, very good. Banks, okay, I said banks already. Okay, one more, 3 more. Utilities, very good. No, energy, no. Consumer, okay. Okay, REITs, banks, utilities, consumer, and one more. Okay, one more, it could be industry. And then this industry maybe is those stable industry, okay, that are supplying to the factories on a long-term continuous basis, chemicals or whatever. Okay, so plantation also can. Okay, plantation also can. So these are the dividends, and then you can make 100K, maybe 20K into each of these sectors. So that means that your banking stock cannot be more than 20K because it's 20%. So if let's say you want to buy these three stocks, Maybank, Public Bank, and NBSB, let's say you want to buy these three, then you have to divide your 20K among these three. You get what I mean? So meaning that you are trying to diversify. Even if you are in the banking, right, you are diversifying into three stocks. Then you look at the REITs. The REITs also you can diversify into 3 REITs. And then you look at the three consumer stocks. And sometimes you also want to do some speculation like the oil and gas, right? Like what Seng Hock is suggesting, oil and gas. So then you will assign like a 10% into others whereby it could be oil and gas, it could be glove stocks, it could be any other things that you think that there is a potential for a price appreciation in the short term. Okay, you can assign like 10 to 20% into this kind of a speculative, and then the rest all dividend. Make sure it is dividend. No dividend, don't buy. Okay, so that means no technology already lah, because technology stock doesn't give dividend. So here we are looking at the buy side, Maybank, you buy limit price at this certain price. Okay, so you buy how many? This is in terms of 100 shares, right? So one lot is 100. So you buy 2,000 shares. Okay, so maybe 1,000 share first lah. Okay, 1,000 share, it's 8,000 plus. Okay, so we buy. Okay, buy, order. And then, okay, buy. Okay, so that's it. Very easy. You click the buy order, and then you go to the order status. Okay. Can you see you can see my order status, right? Okay. So order status, you will see that, okay, it's buy and it is queuing. Okay. So if it's done, then it will say it is done. Okay. So I think it's done. Okay. So it's done, filled already. So the status is filled, and then so it's done. So when you see the status is filled, then it is done. Okay. So that's very simple. And it is safe. You feel like when you buy all these dividend stocks like REITs and the banking, and as long as there's no severe kind of a recession, okay, we just came out from that pandemic, right, when everything is locked down. So as long as there's no like severe like war thing or recession, these dividend stocks, they are operating in a relatively stable industry. So then the dividends will be quite consistent. Okay, so while the stock market is boring, okay, we understand, then we just focus on collection of the dividends. Okay. So I think any question about this opening account for this Bursa Academy? Any question? Okay, so this trading okay or not? Okay.
Yeah, I think so far it's okay. Looks like no question on equity trading simulator as of now.
So then maybe I will answer some of your questions. Okay,
let me take those questions. Of course, if you have any questions to ask Pauline, you may keep the questions coming. Type the question in the Q&A box, yeah, not the chat box. So the first question is non-farm payroll same as unemployment rate?
It's different because unemployment rate is a generic term that include non-farm payroll, job data, unemployment benefit claim, and then you have many sub employment data. So unemployment is more like a general term. Okay. Yeah.
Actually, unemployment means how many people are unemployed at this month, and non-farm payroll typically tells us how many jobs are created in that month. Yeah, that belong to non-farm. Okay. The next question by Shazila is, with the current economic situation, which may be quite volatile, what would be the most appropriate strategy to trade in this current situation from your perspective?
Okay, I think this one I have mentioned, which is you need to diversify. And then at the moment, to me, I find that dividend stocks are still okay. So while the market is very boring, and I feel that we don't look at the price at the short term for too much, and then we just focus on the income stream, and that will make you feel better. Otherwise, you feel very. Another thing is that you may also invest in fixed income. Okay, fixed income. To get the higher interest rate.
Yeah, we also have a fixed income security that are listed on the Bursa Malaysia, and that is exchange traded bonds and sukuk.
Oh, okay.
The next question is by Sheila, which is, the market is usually 6 to 9 months ahead and have already factored in recession in America. And with the anticipation of a pause or a tapering in interest rate hike in US, moving forward, do you see the market to start rising in the second half of 2023?
Okay, there is a possibility. Okay, because with the news of a pause of interest rate, then the short-term effect is that, oh, there's a relief, and then the market will rally. And after all, the market has been down for the first half, right? So naturally, the chances of the second half to rally is high. But after the rally, what's next? So that's the thing. So this rally could be temporary. Yeah.
All right. Let's do one last question before we wrap up the session. So would you be able to share, what do you think about the Japanese yen outlook? That's by Lily.
I feel that, okay, the Japanese yen didn't perform as good as my prediction, because I'm looking at the inverse relationship, right? So meaning that when the US dollar is weakening, then the Japanese yen normally will be better. But however, when I look at the chart, it didn't go high enough to my expectation. So it is like still on a still facing some resistance. So I think maybe we just have to wait until the next FOMC, whether there is a rate pause or there is a continuation or rate high or whatever. Until then it will be a better or clearer picture for the Japanese yen. It will have to be at least a pause first. Okay, then the Japanese yen may be improving.
All right, let's do one last question by KS. With the looming recession, will property investment be a better hedge?
Okay, the property investment, there are a lot of factors. Of course, interest rate is one of it, but recently I do see that the supply is another issue of the property. I see that this year, I don't know why so many new developments are launching their property. So all are happening this year. So the competition will be very stiff, and then you are looking at probably the price may not have a price appreciation within this few years because of oversupply. So I'm worried about that oversupply issue.
All right, so that's your view, yeah. So how do you see the China market in the next 2 years?
The China
next
market,
2 quarters. Yeah.
Okay. Oh, next 2 quarters only. Okay. Will be good, because I'm looking at with the current the new leadership, especially the Shanghai Li Qiang. He was from Shanghai before, and he's actually a person who is pro-business. So, and but we want to see whether how pro he's towards a business. And recently we do see Jack Ma coming back to the limelight, and hopefully we want to see the tech stocks to increase further. But at the moment, the tech stocks are still not doing too well. But it has gone up ever since, they took over, but they have gone up. But still, now it's having some correction. But I would think that the China economy should be improving, okay, because it's a very large economy. So unless they have a bad policy, the only problem with China is their policy, and that policy is controlled by the central 1%. So that is the only risk. Yeah.
Okay, let's do one last question. Do you see oil price maintain or increase moving forward in 2023?
I think it will just horizontally, and then it will not go higher. It will not go higher, but then just horizontally, and until there is much news. Yeah.
Okay. All right. Thanks, Pauline, for sharing your perspective. And I want to reiterate that all these views are presenters' view. So of course, you have to do your own due diligence. All right.
Okay.
So in a nutshell, the equity trading simulator is a risk-free simulator for you to practice your trading strategies. in a virtual trading platform, but of course the price movement is real time. You can create a portfolio, you can test the market order, you can practice your portfolio management or money management strategies in a risk-free virtual environment where all the prices are real time. So this is a virtual simulator that can help you to gain experience for to improve your trading performance and to understand your trading system. All right. So ladies and gentlemen, you just heard from the director of Sigma Wealth, who is Miss Pauline Yong. Thanks, Pauline.
Thank you. Thank you. Thank you, everyone. Bye.
All right, so for our next webinar, it is titled Rahsia Penggunaan Strategi Silang Emas Golden Cross untuk jana keuntungan consistent. So the next session is going to be in Malay. So it is happening on the 15th May 2023. It's a Monday, 8:30 to 10 p.m. So I've just given you the registration link. So yeah, if you want to learn how do you use Golden Cross to create consistent profit, you may register for our session on the next Monday. I've just given you the registration link in the chat box. All right. So thanks everybody for joining the session until the end. So hope you all have a great rest of the day. Okay. Bye everybody. Hope to see you in our next webinar.